Okay, welcome back. We're at 19-2. Now we're going to talk about the 5 components that will actually change that PBO, or projected benefit obligation, year over year, right? Because every year, at the end of the year, we need to know how much that obligation is. So this is our obligation to pay our future benefits. Also, I want you to know that there's going to be plan assets as well, right? And we're going to have pension expense. So the way this will work for companies is they've got these plan assets, right? And then they've got the liability, because what they're doing is they're saying, hey, I know I've got to pay you, something in today's dollars that's $1,000, right? In a perfect world, what they would do is they would debit expense for $1,000. Let's assume it was the first year of the company, and they would credit cash. Where does that cash go? It goes into the plan assets. Now remember, this is not a 401k. These aren't the employee's assets. The company is managing these assets. If the company does this just right, this plan asset will turn into the amount needed when the employee retires, and they'll be able to use those assets to pay the employees, right? So where the rub comes in is that it's really hard to figure out how many assets you need to get that number right, to figure out your liability, and then also your pension expense. So let's start on going through the measurement of the pension benefit obligation. All right, so we've got a beginning balance. This assumes we've been in business for a while. We're going to add to it this concept of service cost. We're also going to add in interest cost, any prior service cost adjustment, these actuarial gains, and then we'll take out any benefit payments. Because if we actually, pay some of those pensioners their benefit, we lose some of the liability, right? It decreases. Service cost is associated with our current period. So that's people have worked, they've earned more benefit right to these benefits in retirement. So that tends to deal with this current period. Interest is associated with the fact of time value of money, right? We talked about the fact that our liability is in today's dollars, but if we owe that money 20 years from now, right, we need to account for the fact that that liability is growing as time passes. If we decide to adjust our plan retroactively, we might have this prior service cost adjustment. And then we've got this thing, actuarial gains, actuarial losses. That's a catch-all for saying all the people that make these estimates on how long people will work, what they might be making, how long they might live, those are called actuaries, right? And as their estimates change, we need to flow that into the liability. And then again, we take out those benefit payments. So service cost is always going to increase the obligation, right? Because if my employees work more for me this year, and I have promised them